Good evening, everyone, and welcome back to America Today, your go-to source for in-depth coverage of the stories that matter most to our nation. I'm your Jack, and today, we are telling you about this critical update on the U.S. labor market, one that's raising eyebrows across Wall Street, Main Street, and right here in Washington. The latest numbers from the Labor Department's Job Openings and Labor Turnover Survey, or JOLTS, paint a picture of a cooling economy, with job openings slipping to 7.2 million in July. That's down from 7.4 million in June, and it's coming in below what economists had anticipated. We'll break it all down for you, including the ripple effects from Federal Reserve policies, President Trump's trade wars, and what this means for everyday Americans looking for work. Stay with us as we dive deep into the data, hear from experts, and look ahead to Friday's big jobs report. Let's start with the headline figures from this JOLTS report, released just this morning. U.S. employers posted 7.2 million job vacancies in July, a modest decline that signals the labor market is losing some of its post-pandemic steam. The drop was particularly sharp in key sectors. Healthcare and social assistance saw openings plummet by 181,000, while retailers cut back by 110,000 positions. These aren't just numbers. They represent real opportunities drying up for millions of workers in industries that have been lifelines for the economy. Layoffs ticked up slightly, adding to the sense of unease, but the number of Americans quitting their jobs held steady at 3.2 million, suggesting people aren't as confident about jumping ship for better gigs as they once were. 82. To put this in perspective, folks, job openings are still at relatively healthy levels compared to pre-COVID times, but they've been on a steady downward trajectory since hitting a record high of 12.1 million back in March 2022. 82. That peak came as the U.S. economy roared back from lockdowns, with businesses scrambling to hire amid stimulus-fueled demand. Fast forward to now, and we're seeing a normalization, or some might say a slowdown, that's been influenced by a mix of factors. Chief among them, the Federal Reserve's aggressive interest rate hikes in 2022 and 2023, aimed at taming inflation, which have made borrowing more expensive for businesses and cooled expansion plans. 64. Add to that the uncertainty from President Trump's ongoing trade wars, which are paralyzing managers and putting a damper on hiring decisions. 72. Speaking of the Fed, let's talk about how those rate hikes are playing out in the job market. The central bank raised rates 11 times to combat soaring prices, and while inflation has eased, the lagged effects are now hitting employment. 62. Higher borrowing costs mean companies are less likely to invest in new projects or expand their workforce. We've seen this in sectors like manufacturing and construction, where financing big-ticket items has become pricier. 64. Economists point out that as rates stay elevated, the risk of a sharper slowdown increases, potentially leading to more layoffs down the line. 63. But there's a silver lining. Fed Chair Jerome Powell has hinted at possible rate cuts if the labor market weakens further, which could juice hiring by making loans cheaper for businesses. 67. In fact, markets are betting on at least one cut before year's end, though the size, 25 or 50 basis points, remains up for debate. 70. Now, turning to the trade angle, President Trump's policies have been a wildcard for the economy. His administration's tariffs on imports from China, Europe, and other trading partners were meant to protect American jobs, but the data tells a more complicated story. 72. Businesses report that these levies are raising costs for raw materials and components, forcing them to rethink hiring. 73. A recent survey of 1,500 business leaders found that 1 in 5 are creating new roles just to navigate the changing trade landscape, but overall, tariffs are stifling job creation rather than boosting it. 73. In manufacturing, for instance, the uncertainty has led to modest job losses, echoing findings from the 2018-2019 U.S.-China trade war. 78. Trump's team argues these measures will bring jobs back home in the long run, but critics say the immediate impact is higher prices for consumers and slower growth. 80. With tariffs affecting about 69% of U.S. goods imports based on 2024 volumes, the drag on hiring could persist. 81. Heather Long, chief economist at Navy Federal Credit Union, nailed it in her social media post today. Job openings in July dipped below the number of unemployed Americans, 7.2 million versus 7.24 million, for the first time since April 2021. 32 inches. This is yet another crack in the labor market that illustrates how much harder it is to get a new job right now, she wrote. 32 and she's not alone. Social media is buzzing with reactions. On X, users like @JC_econ highlighted a pretty rapid cooling in labor demand, while @econ_Parker noted that the convergence of hiring and separations leaves the economy in a relatively fragile state. 42 traders and analysts are echoing this sentiment, with posts pointing to increased odds of Fed action. 44. All eyes are now on Friday's unemployment and hiring report for August. Forecasters surveyed by FactSet expect businesses, governments, and nonprofits to have added about 80,000 jobs last month, a slight uptick from July's disappointing 73,000. 53. But remember, July's figures came with a sting. Revisions slashed a whopping 258,000 jobs from May and June payrolls. 11. That bombshell prompted a furious response from President Trump, who fired the head of the Bureau of Labor Statistics and nominated a more partisan figure to take over. 74. Critics are calling it an attack on independent data, but the White House insists it's about ensuring accuracy amid economic uncertainty. So far this year, job growth has averaged just 85,000 per month, half of last year's 168,000 and a fraction of the 400,000 monthly boom from 2021-2023. 91. In times like these, employers are holding on to workers but hesitating to add new ones. It's a classic sign of caution. No mass firings yet, but the hiring spigot is tightening. 14. This dynamic is playing out across industries. In healthcare, despite the drop in openings, hiring held steady, but quits rose in professional services while falling in construction, hinting at sector-specific pressures. 82. Manufacturing, hit hard by tariffs, saw openings decline further, while tech and finance are feeling the Fed's rate squeeze. 76. What does this mean for you, the viewer? If you're job hunting, competition is fiercer with more unemployed chasing fewer spots. 3. Wages might stagnate as bargaining power shifts to employers. 87. For businesses, it's a wait-and-see game. Will trade talks resolve uncertainties? Will the Fed cut rates to spur growth? 79. Broader economic implications are huge. Slower job growth could curb consumer spending, which drives 70% of GDP. 88. Yet, resilience remains. Low layoffs mean no recession alarm bells just yet. 90. Looking historically, this cooling mirrors patterns after past rate hike cycles, like in the early 2000s. 83. But with trade tensions added, it's uncharted territory. 75. Experts like those at J.P. Morgan warn that labor supply growing faster than jobs could push unemployment higher. 84. On X, Gareth Soloway called it a weakening quickly market, boosting rate cut bets. 44. Meanwhile, Nick Timiraos noted steady quit rates but dropping openings. 46. Political fallout is intensifying. Democrats blame Trump's tariffs for the slowdown, while Republicans point to Fed policies. 74. The BLS shakeup has sparked debate over data integrity. 74. As we approach midterm elections, this could sway voters worried about pocketbook issues. In wrapping up, this JOLTS report underscores a labor market at a crossroads, cooling but not collapsing. 84. Friday's data will be pivotal. If August disappoints, expect louder calls for Fed intervention. 53. We'll keep you updated right here on America Today. Thanks for watching. Don't forget to subscribe our channel.